B. Draft treasury policies and procedures for approval, such as investment, FX, risk management, hedging, credit approval. Drafting treasury policies and procedures is a critical treasury management responsibility because formal governance frameworks establish the standards, controls, and responsibilities necessary to protect organizational assets and support effective financial decision-making. Treasury professionals develop policies that guide activities related to liquidity management, investments, foreign exchange, debt management, hedging, payments, and risk control. Policies provide strategic direction and define acceptable levels of financial risk, while procedures describe the operational steps required to execute treasury activities consistently and accurately. Well-designed policies improve transparency, strengthen accountability, and ensure compliance with regulatory requirements and organizational objectives. Treasury professionals collaborate with senior management, legal departments, accounting teams, auditors, and boards of directors when preparing policies for approval and implementation across the organization. Investment policies are among the most important treasury governance documents because they define how organizations manage excess cash and protect liquidity resources. Treasury professionals draft investment policies that establish objectives related to safety, liquidity, diversification, yield expectations, maturity limits, and approved investment instruments. Policies also define counterparty credit requirements, concentration limits, reporting standards, and authority levels for investment decisions. Treasury teams must balance the need for capital preservation with the desire to generate appropriate returns on surplus funds. Procedures supporting investment policies describe approval processes, transaction execution standards, monitoring responsibilities, and reporting requirements. Effective investment policies reduce market and credit risk exposure while supporting prudent financial management and organizational liquidity objectives. Foreign exchange and hedging policies are essential for organizations exposed to currency fluctuations, interest rate volatility, or commodity price changes. Treasury professionals draft policies that define the purpose of hedging activities, approved derivative instruments, risk exposure limits, documentation requirements, and authorization procedures. Organizations generally prohibit speculative trading and require hedging transactions to support clearly identified business exposures. Treasury policies also establish governance frameworks for monitoring hedge effectiveness, evaluating counterparty risk, and reporting derivative activities to management and regulators. Supporting procedures explain how exposures are identified, measured, approved, executed, and monitored throughout Treasury operations. Effective foreign exchange and hedging policies help organizations reduce earnings volatility, stabilize cash flows, and strengthen long-term financial planning under changing market conditions. Risk management and credit approval policies are critical because Treasury operations involve significant exposure to financial institutions, counterparties, customers, and market uncertainties. Treasury professionals draft policies establishing risk assessment standards, credit evaluation criteria, counterparty exposure limits, and approval hierarchies for financing or investment activities. Policies often define procedures for evaluating creditworthiness using financial analysis, credit ratings, liquidity measures, and market indicators. Treasury teams also include controls governing payment authorization, segregation of duties, fraud prevention, and operational monitoring. Effective risk management policies improve governance and reduce the likelihood of financial losses resulting from operational failures, market disruptions, or counterparty defaults. Strong procedures ensure Treasury activities are executed consistently and in compliance with organizational risk tolerance and regulatory expectations. The policy approval process requires Treasury professionals to communicate clearly with executive leadership, boards of directors, auditors, and regulatory stakeholders regarding policy objectives and operational implications. Treasury teams prepare supporting analysis explaining why policies are necessary, how risks will be controlled, and how procedures align with organizational goals. Policies must be written clearly and comprehensively to ensure employees understand expectations and responsibilities. Treasury professionals may also coordinate policy reviews with legal, compliance, tax, and accounting departments to confirm regulatory alignment and operational feasibility. Once approved, Treasury teams communicate policies throughout the organization, provide employee training, and establish monitoring procedures to ensure effective implementation and ongoing compliance with governance standards and operational requirements. Treasury policies and procedures require periodic review and updates because financial markets, regulatory requirements, technology systems, and organizational structures continuously evolve. Treasury professionals regularly assess whether policies remain effective in addressing emerging risks, operational changes, and strategic priorities. Internal audits, external examinations, and operational performance reviews may identify areas requiring policy enhancements or procedural adjustments. Treasury teams also evaluate lessons learned from operational incidents, fraud attempts, cybersecurity threats, or market disruptions to strengthen governance practices. Effective policy maintenance improves organizational resilience and supports continuous improvement in Treasury operations. Treasury management systems and reporting tools also assist in monitoring compliance and identifying policy violations or operational weaknesses requiring corrective action or procedural updates.